Just this last week, I had a slight revelation that was understanding when I should be holding for a big winner and when I'm better off going for a base hit. And so I wanted to make a video kind of talking through that and what I learned and what I'm going to implement in my own trading. So to start with, I'm sure you've had a trade that looks really epic, you're really happy with it, you're holding for your 2-hour targets, but then it reverses against you and stops you out for a loss. Or on the other hand, you might have been in a trade that you were happy with, it goes and hits your targets, and then it continues the rest of the day without you. And I know I've been in that situation a lot of times, and it can be kind of frustrating. Even if you took a win, it can be a bittersweet moment. Base hits are more consistent. What I mean by that is, if you imagine the law of large numbers, it basically states that the more data points you have, the more the results will converge towards the expected value. For example, if we have a whole bunch of results, and if you imagine each one of these points being a trade, you can see that on average, it is a pretty steady curve. Versus, on the other hand, if you were to have high R trades and then multiple losses in a row, and then another higher trade. And if you look at this equity curve, sure, it starts at a similar area and ends up in a similar area, but in the meantime, it's very volatile, and that's going to weigh a lot on your psyche. And yeah, it's just not the ideal way to trade. By definition, more consistent with those base hits. But there is a time and place for taking those higher trades. I'm sure you've heard of traders, they say that it's those big winners that really make their week and their month. And then there are other traders who swear by their base hits. They go for those 1-to-1s or even less, and they just stack those up consistently, and over time, that is what makes them consistent. Now you may question, who exactly is right? Low R versus high R? Well, really it depends on the context, your strategy, trade management, and even mindset. By recognizing specific market conditions, you can objectively identify when it's best to hold for those high R versus when you should be going for that base hit, and that is what I'm going to be demonstrating here. So in this video, I'm going to focus on one of the main factors, which is essentially trend direction, but it comes down to two things. That is the high time frame draw, which is the destination price is going to, and also the mid time frame trend direction. So for the high time frame draw, you can see I'm on the daily time frame right here on gold. Recently had this heavy pullback, then identify, okay, where was price actually heading? Well, we have these 3 daily lows down here, a large pool of liquidity. In this down leg right here, you could say that we were drawing towards that area. So I'm just going to draw a box there to represent that, and that is essentially the high time frame draw. In this particular area, price was drawing lower towards those lows. Now for the mid time frame, which is the other factor, so we've got those two factors. The first one being that high time frame targets, the high time frame draw, and then the mid time frame trend direction is the next one. What we can see here in this particular leg here, the trend direction on the hourly time frame was lower. Then in this next leg, you can see it was actually heading higher. In the next leg, it's heading lower, etc., and then eventually goes lower into that target. Now, right away, you should be able to see that the optimal situation is when both the trend direction and the targets are both in alignment. So I'm going to jump over to a clean chart and draw up a bit of a diagram to represent this. So there are 3 variables I can think of, and the first one being the front side versus back side of a move. So I'm going to draw up a few little charts, bit of price action you can see there, and we will draw this up with separating the front side and back side of the move. Now on the left we have the front side, then on the right we have the back side. Then the next factor we have is that target, that high time frame draw. So I'm just going to draw a box out again, and then we can duplicate this and do our final factor. So essentially front side is when price is moving away from that high time frame draw, and then the back side of the move is when price is moving towards that high time frame draw. A lot of the time people want to jump in on the front side, whereas on the back side a lot of the time is actually less risky, although it can feel more risky. Now the final variable is short versus long. I'll draw up a few examples on this chart and we'll see how each of those compare to each other. If we were to take a short on the front side of the move, let's say here we see our entry, we take a short, we put our stop at the high, we're targeting that high time frame target. Price could move in our direction a bit, but then reverse against us and stop us out quite easily. So this would be an example where it's a great idea to take a base hit. Then if we took another short, but this time on the back side of the move, and we put our stop wherever we're going to put it. Now at this point, the mid time frame is in alignment with that high time frame target. So this is where it's optimal to give your trade a bit of breathing room, hold for those larger targets, and just manage your partials accordingly. So on the other side, we have if you were in the same situation with that high time frame draw being below you, but you're this time looking for a long. So if you're on the front side of the move, sure, price is moving higher in your direction. So if you were to take a long down here, then there's nothing wrong with that. But what you'll notice about this is that price will head in your direction, and then aggressively reverse against you, likely taking you out of break even or for a full stop, like it might even come down here. So it's very high resistance, and so locking in those base hits is going to be a lot more consistent over time, because you can potentially take 1, 2, 3 trades in here and to have winners if you took base hits, or you might get stopped out on all 3 of them if you're holding for a big run. But I'll just leave that one over here for now, and then we'll compare that to what happens if you take a long on the right side of the curve, so on the back side of the move, with that same scenario of that high time frame target being below you. Now this clearly is the worst time to be taking a long, but that doesn't mean that there won't be a situation where you could take a long. For example, on this little pullback, we get a nice aggressive run higher. Sure, you could take a nice win there. So what happens if you try and hold for that big win? Well, it could aggressively move against you and stop you out. However, if you were to lock in that base hit, you might be alright. I will go over a couple of examples right now just to represent this with real price action. We'll use this exact same scenario with price going lower on this goals chart. And I'll jump over to the hourly time frame. You can see very clearly the trend was heading lower, then higher. So we'll focus in this kind of area, but I'll actually drop down to a 5-minute chart now. And already you can see roughly what we're looking at. So I'm going to move this up so we can see it. But you can see that the draw was lower, and we have this trend heading lower, then having this pullback. So this represents the front side of the move, and this is the back side of the move. Now, because we know price is lower, let's say we're looking to take a short. If we're looking to take a short here, obviously that had a beautiful movement lower, and if you were to be in a trade at this point, it would make sense to hold for a bit of a runner, because price is moving in that direction of the high time frame target, and the mid time frame is in that direction of that trend. We're still heading lower on that mid hourly time frame. However, if you then were to take a short over on this side, the mid time frame is moving in an uptrend, which is against that high time frame draw. So if you were to take a short, you're best off locking in a base hit. And finally, for the shorts, if you were to take a short on the right side of the curve, so on the back side of the move, in the direction of that high time frame draw, that's when the probabilities are really in your favor. Be optimal to leave something on, give it a chance to run, and see if you can get a few extra R out of that trade. And finally, if we are looking to take a long position, you can see that price did in fact head higher from this low up towards this high. So there's nothing wrong with taking it long. However, you also want to be locking in those base hits, because as you can see here, if you are targeting all the way up here, it eventually reverses against you, and in the meantime it has these runs in your direction, but then a very aggressive pullback all the way to your break even, which could even stop you out for a loss. So the final example would be if you are taking a long against that high time frame trend direction and that high time frame target. Let's say you took a long right here. That's a very nice spike up and towards the highs. However, it doesn't go very far before aggressively reversing against you. So you'd essentially want to be locking in that base hit, rather than trying to target a massive winner. And that's what's going to give you the consistency over time. It's recognizing if you are on the front side or the back side of the move, recognizing where the target is on the higher time frame, and then adjusting how you trade your shorts or long positions accordingly. If this has been insightful, or if you have a slightly different way that you like to manage your profit taking, I'd love to hear about it. So leave a comment below, and until next time, God bless and good trading.